Welcome everyone, thank you for joining me. I'm David Koenig, founding principal of TGF Analytics. Before we begin, just a few legal disclaimers about this presentation. This presentation is for information purposes only. We're not giving investment advice for specific situations, nor are we inviting or inducing any investment activity or selling securities. We believe the sources of our data to be reliable. Our analysis can change over time and may not be current if viewing a replay of this presentation. Be sure to engage proper investment advice for your situation. Investment managers seek to use their investment capital, their risk capital, to create returns for their clients. They have four general goals in providing this service. First is to enhance portfolio returns. Second is to reduce the downside risk of those investments. Third is to fulfill the fiduciary obligations in their role. And fourth is to beat competitors. Whatever fiduciary criteria you're seeking to satisfy, meeting pension obligations, endowment funding of expenses, or competition with other investment advisors for AUM, these four goals apply. And we always have to be asking, can we do these better? That's our goal with portfolio shaping. So let's take up a challenge. Today our goal is to improve the combined portfolios of George Soros, Bill Ackman, Carl Icahn, and Charlie Munger through a simple portfolio shaping exercise. The companies in our evaluation portfolio are holdings of theirs as of the end of 2017, and we're going to look back at them over about 3 years. As of December 31st, 2014, our starting point, their combined portfolio had these characteristics. Roughly 150 companies, about 60% of which were large cap, 35% mid cap, and just under 10% were small cap. The median cap was $15 billion, while the average cap was $45 billion, suggesting a number of large companies were in the portfolio. The smallest company in the portfolio was just over $500 million in size, and the largest was around $400 billion. Here are the names in the portfolio. You can come back and look at them later, but they're the ones you'd expect to see. In other words, our evaluation portfolio hasn't been seeded in any way so that it works well here. From the full portfolio list, we've removed some names for which there was insufficient data in our models. We require 5 years of market data for some of our metrics. And we removed a couple that fall outside of our evaluation universe. But it's a solid, diverse portfolio, as you'd expect from this astute group of investors. Our initial evaluation period is interesting for a few reasons. First, there are two large sell-offs, a loss from the start date of 9.1% and another of nearly 14%, with a drawdown from peak value that was even higher. Second, there are subsequent recoveries to each sell-off. Finally, on net, the market winds up essentially unchanged despite the two volatile downside moves. This kind of an environment gives us a good chance to see whether there are forward-looking risk measures that help us to differentiate strong and resilient companies from those that are more fragile and vulnerable, and to further see if this differentiation helps us to achieve our four goals. We'd especially like to know if such measures can even improve on a portfolio created by these legendary portfolio managers. So how did their elite portfolio do? Well, pretty well. Over 12 months, the Soros, Ackman, Icahn, Munger portfolio outperformed the broad market by 50 basis points. But over 18 months, that outperformance expanded to nearly 600 basis points. It achieved an in-line to slightly lower level of volatility, which in combination with the extra returns meant that it realized better Sharpe ratios. What seems more remarkable is the limited drawdown, more than 400 basis points superior to the broad market. They did well. So let's look at the performance of the portfolio components. This picture is interesting because of the dispersion of performance. Each line in the graph is one stock in the portfolio adjusted to a starting price of $1 and tracked daily over the 18-month period. As we examine this, we note that many of the stocks in the portfolio declined in value, not just during the market sell-off, but in the end as well. Like most portfolio managers, though, our experts didn't need to be right about every stock pick to wind up with a net gain, and they weren't. In fact, 47% of their picks lost money over this time. One of the reasons they can have such a low success rate is that a couple of very strong performers helped to draw the overall portfolio higher. We can look at this dispersion in a different, and I would argue more helpful way. We'll take the NAVs of each individual stock, slot them into return buckets, and display the performance of the portfolio components as a histogram. Then let's turn it so it looks more familiar. connect the bars of the histogram with a slightly smooth line, allowing us to see that this portfolio has a kind of shape to it. It's not a normal bell curve shape, and it's not quite log normal, but it's close. This is the starting point for building out the concept of portfolio shaping. We want to reshape this distribution to be even better, to get more upside and even less downside. To do that, we're going to need to understand the impact of both risk and expectations on the value of individual stocks, and to look for ways to measure those factors. Enter the value equation. This relatively simple formula can be used to value any transaction or any financial instrument. It can even be used for non-financial transactions or decisions made within our bounded rationality as human beings. But here we focus just on how to use it to value equities. There are a few components to the value equation that matter to us. First, let's look at the numerator, the top part. The D's represent future expected things of value to shareholders. These might be dividends, or they might be proxies for future dividends or expected capital gains, like free cash flows or economic profit. And finally, the last entry on the right is the return of some amount of principal when the stock is sold. The denominator on the bottom is where we discount the future cash flows or their proxies by some amount. The discount rate is determined by the risk that we might be disappointed by reality relative to our expectations about these future dividends or the final sale price, the cash flows that are on top. Remember, a number in the denominator that is lower makes the price go higher, or conversely, when it's higher, makes the price go lower. And N is the number of cash flows we expect to receive and a measure of the time until we expect to sell the stock. This equation has its roots in fixed income valuation. Cash flows and equities are different from traditional bonds, though, in that they're always of uncertain size and sometimes of uncertain timing. In that regard, they're more like mortgage-backed securities whose cash flows depend upon when homeowners sell or refinance their homes. The final cash flow when the stock is sold is always of uncertain timing and may or may not be at a time of our choosing. To account for all of these uncertainties, as with almost all financial instruments, we have to apply some kind of risk discounting to future cash flows. For equities, this is commonly called an equity risk premium over the risk-free interest rate. The sum of all of these future cash flows, discounted by the combined risk premium and risk-free rate, is its value today. That value should equal its price, or there's further investigation to do to see if either the market or our expectations or both are wrong. So to repeat, what impacts the value today is what impacts the numerator. We want larger dividends, larger cash flows, and a higher price when we sell. And if there's any reason that the number of periods we expect to receive dividends changes, N, that changes the value today. Finally, anything that changes our assessment of risk around the expectations of future cash flows, anything that makes it more or less likely that we'll be disappointed, changes the denominator, and that changes the value of the stock to us today. In essence, the process of valuing a company today is speculation about how these factors might be different from our expectations or the market's expectations, and what the distribution of future stock prices might look like. How safe are our future cash flow, earnings, and dividend projections? What does the market think? What are the various earning estimates? How predictable have earnings been in the past? What about implied future volatility, and what if these don't agree with each other or our analysis? We're looking to understand risk. In general, for portfolio managers, the approach to addressing these uncertainties has been to rely on the benefits of diversification, reduce the impact of idiosyncratic risk, and wave the white flag of surrender to market risk. This is not an understanding of risk, and it gives our competitors an opportunity to outperform us. Can an understanding of how risk is priced into a stock help us move beyond just diversification? Can we find some proxies for future risk? Are there any indicators suggestive of a higher likelihood of disappointment, higher risk than we priced in originally? What we're asking is whether there are some forward-looking, non-traditional measures that help us to know if a company is likely to outperform, continue to underperform, or if its fortunes might change, and if so, by how much and in what direction. At TGF Analytics, our approach to calculating these factors is to ask dozens of questions about risk, risk expectations, valuations, substitute investments, governance, both financial and more traditional ESG, market psychology, institutional psychology, potential accounting manipulation, and changes in all of these things. From this long list, we're able to assemble something we call sustainable value grades for each company that we analyze. These sustainable value grades give us a unique way to compare stocks across industries, sectors, risk factors, and more. When you use these in addition to traditional methods, a picture will emerge on some companies that is very different than you might expect if you simply read financial statements or analyst reports, or even if you use traditional ESG analysis. We want to know if the risk we're taking is being sufficiently rewarded. Is our investment more sustainable than others or not? Is it likely to help us achieve our 4 goals, or is there something hidden that makes its relative value less sustainable? Here are some pictures of the data behind our sustainable value grades. This is a report on Deere & Company from early in March of 2018. I highlight 2 evaluations of quality for Deere, which are suggestive of high and growing risk. Of course, this is just a quick snapshot, but it's shown to illustrate that our sustainable value grades look across many factors to highlight companies that could be either opportunities or inefficient users of capital with substantially more downside risk than the market realizes. Deere receives an F- for quality. Yes, we give F-, and as the chart in the lower left corner shows, its relative quality to the market has been steadily deteriorating over the past 3+ years. If Deere is in your portfolio, you'll want to continue watching, and if not, you may be surprised to find out just how many companies there are like Deere and which may be in your portfolio now. So on to the process of portfolio shaping and how information like that we have on Deere can help us. First, let's go back to the shape of a stock and then ultimately to changing the shape of a portfolio. Companies that have a higher likelihood of disappointing investors have a different look to the distribution of possible future values. Companies with large risks are more likely to experience large downside movements from earnings disappointments, financial restatements, acquisitions that don't meet expectations, or simply from losing competitive advantage and realizing subsequently less opportunity for growth. They have less upside opportunity, which in combination with their downside risk gives them what is called a negative skew to their potential future values. Well-run companies are the opposite. They innovate, they're resilient in the face of challenges. If there's a disappointment, they reshape and rework to meet the challenge, and they're rewarded by the markets for it. They have longer upside tails because they foster big innovations and success. Their resiliency limits the downside. The distribution of their possible future values is skewed positively, and their expected value, therefore, is higher. In other words, they are more valuable. Looking again at Deere & Company, the 2 graphs show a growing disparity between trends in quality and Deere's stock price. Usually these discrepancies are unsustainable and factor negatively into our sustainable value grades. When these are presented to us in our models, we have to ask, is the market right and something big is about to happen that will reverse the trend in quality? Or is the trend in quality a warning sign? Can we find other indications that something is not right and not yet well understood by the markets? Like any good mystery, you follow the clues and build a case, trying to understand if this stock is likely to have a negative skew or a positive skew to the distribution of future prices. The process of portfolio shaping is to do the same analysis on all positions in the portfolio and to highlight those that deserve more attention, those that look more likely to fall into the brittle, higher risk category. Using traditional metrics or even widely available ESG ratings, portfolio managers can make some determination about risk. But not all companies that appear to be bad risks are in fact so, and not all value stocks are truly a good deal. Some companies that have stellar ESG reviews are in fact very risky portfolio investments. Remember, even our 4 superstars have a portfolio where only 53% of the stocks went up during our evaluation period, and you know, every stock they bought they expected to go higher in value. We're working to change the shape of our portfolio to a more positive skew by getting rid of the companies that have a bad shape themselves, and if allowed, we might even go beyond just getting rid of them. These 2 scatter plots show some of the key relationships we look for in our analysis. The one on the left plots sustainable value grades specifically for the 2 factors, financial governance and ESG. Note the grades on the 2 axes range from A+ to F-. It's pretty clear from the scatter plot on the left that our 4 experts are not incorporating financial governance and ESG measures in their portfolio construction. The 153 stocks are all over the place and almost evenly distributed among the 4 quadrants. For any portfolio that looks like this, there's usually an opportunity for effective portfolio shaping. The scatter plot on the right shows the relationship between an interplay of governance, quality, and value. The Soros, Ackman, Icahn, Munger portfolio has a significant number of companies in the danger zone, shown by the lower left quadrant. Again, there's an opportunity here for successful portfolio shaping. to give their portfolio a more positive skew to likely future performance. We typically like companies in the upper right quadrants, and we're more typically skeptical of those in the lower left quadrants. So for demonstration purposes only, we're going to do a simple portfolio shaping exercise and remove all of the companies in the portfolio that fall into the lower sustainable value grades for these three factors: financial governance, ESG, and quality. Doing this, we remove many of the stocks that are potentially most dangerous. I want to re-emphasize that this is a very simplistic example, but as you'll see, still effective. Here's how the original portfolio stocks performed, and on the right side is the shape of that portfolio. The second set of charts are the companies that we excluded. You'll note the mean return shifted to the left, and more companies showed losses. That's characteristic of a portfolio with a more negative skew. And the third set of charts is our shaped portfolio. The mean is shifted slightly higher, and there's been some positive change in the shape. It has a more positive skew. Remember, the Soros, Ackman, Icahn, Munger portfolio outperformed the broad market, but here our shaped portfolio outperformed their portfolio by 170 basis points over the first 12 months and 240 basis points over the 18-month evaluation period, and volatility was in line to slightly lower, meaning higher Sharpe ratios for our shaped portfolio. In other words, it made better use of the capital. Let's go one step further. Now let's keep the same net exposure in dollar terms, but let's short the excluded stocks in an amount equal to 30% of the portfolio value and increase our long positions in everything else by 30%. The impact is dramatic. 12-month outperformance is now 660 basis points, and 18-month outperformance is now 960 basis points. And volatility is even lower, which means that Sharpe ratios have gone substantially higher, and our portfolio is an even better user of precious capital. The bottom chart shows the shape of our original portfolio in blue and the shaped portfolio in orange. Since we only focused on the stocks with the highest risk, the place where we see the change in the shape is on the left side of the distribution, where losses show up. This line is lower and to the right of the original, suggesting that fewer stocks had losses and fewer had large losses. The result is a shift in the shape to a more positive skew and its associated higher mean. The filtering of these companies from the portfolio was done ex ante. Our sustainable value grades had no knowledge of the forthcoming market movements. Rather, they used forward-looking risk and valuation assessments, including those related to financial governance and ESG, and did them better than even our star managers. We can go even further in our modification to portfolio component weights. Rather than increasing the allocation across all remaining stocks, let's allocate to those existing stocks in the portfolio that are in the opposite quadrant of our shorted stocks. Well, here's the result when we do that. These results may be extraordinary, but they're not surprising. Different market environments yield different results, and markets wherein almost everything goes up without thought or differentiation between poor and good quality means that any filtering program like this can even underperform for some periods. But sustainable value grades help you keep the odds in your favor, making you a better user of the scarce risk capital with which you have been entrusted. So in summary, we compare 18-month returns in the upper left corner across the Russell 3000, the Soros, Ackman, Icahn, Munger portfolio, the shaped portfolio where we exclude the poor users of risk capital, the shaped portfolio where we actually short the poor users of risk capital, and finally where we increase the size of long positions that are in the opposite or mirror quadrant. The other three charts are volatility, Sharpe ratios, and drawdowns. You can hopefully see the impact of incorporating these forward-looking risk measures via our portfolio shaping process and our sustainable value grades. Again, just for illustration purposes, we ran the same portfolio with the same companies excluded and the same longs enhanced for the ensuing 18 months, not making any adjustments to reflect changes in our evaluations of individual companies over that time. So this analysis is based on year-end 2014 data, but performance is evaluated between July 1st, 2016 and December 31st, 2017. You'll note two things. First, the outperformance continued with volatility that was in line to slightly higher. The net impact again was the realization of better Sharpe ratios, even in an environment where the market rallied significantly. Second, there was a brief period of underperformance immediately following the 2016 elections. In our normal work with clients, we update sustainable value grades every month. This allows clients to run the process of portfolio shaping on at least a quarterly basis, or even monthly if they so desire. If you have a portfolio with stocks in the lower left quadrants of our screens, you can benefit from sustainable value grades and using them to engage your own portfolio shaping. Let's see how this might work on one stock. Let's say you do own Deere in your portfolio. If we just look within the same industry and across two charts showing first our financial governance and ESG scatter plot, and second, a scatter plot of risk and quality, we see some interesting opportunities. We see that Deere's ESG rating is pretty good, but its financial governance rating is very poor. So the red dot in the lower right quadrant of the left chart suggests that we might be able to improve. But the right-hand chart is where our concern over Deere & Company is most profound. Its sustainable value grades for risk and quality have it buried in the lower left quadrant. Both were F- when this analysis was run. So a movement of capital to a different company in the upper right quadrant is likely to provide an enhancement to the skew of our overall portfolio if it includes Deere. The process to follow to find those industry substitutes that fit into the upper right quadrants is to do a deeper comparison of their sustainable value grades to Deere & Company. A capital transfer may be warranted, and if so, the shape of the portfolio that previously had Deere & Company in it was just improved. Remember our 4 goals as equity portfolio managers? Whatever fiduciary criteria you're seeking to satisfy, meeting pension obligations, endowment funding of expenses, or competition with other investment advisors for AUM, doing this better is our overall objective. And that's what portfolio shaping and the use of our sustainable value grades help you to do more consistently. Please use the contact information displayed here to schedule an initial evaluation of your portfolio to see if there's some stocks in it that may have hidden risks and may warrant more of your attention. Even if you're as good as Soros, Ackman, Icahn, and Unger, it's likely you'll be surprised by at least a few holdings. And if that's true, sustainable value grades will improve the shape of your portfolio and make you a better investment manager. Thanks so much for your time. I look forward to speaking with you.